Parker is graduated with one of my daughters. So and Caitlin has known my daughter Jill for a long, long time. And so we've crossed paths in the past. And so I am the manager of a CPA firm in Eden Prairie. Of Mavis and Flagart Catalytic and Associates. We've been around for 30 years. I've got 44 years in public accounting. And so I have a little bit of idea what's going on in taxes. I've been working with realtors for a long, long time. I have worked with the Dakota County Association of Realtors, which became the Southern Twin Cities Association of Realtors, and then they became the St. Paul Area Association of Realtors. And so I've been doing that for 37 years. So we meet with the group on a regular basis. I've got their board meeting tomorrow. So I know what you guys are doing. I know what you're going through. We're going to use today as sort of the Ask the CPA. So it's very rare that you're going to get a free hour of CPA experience. And so feel free to ask any kind of questions that you have. If you're watching from home, jump in anytime. We can take care of any questions that you may have. So how are we advancing? Just return? Nope.
I think you should be on that. There you go.
There we go.
So just click on there.
Yep. I am a certified public accountant. I'm also a personal financial specialist, which is American Institute of CPAs designation for financial planners. So I understand exactly, and every one of our clients have the same needs. They want to minimize their tax, provide for a good retirement, and protection for their family. If we do those things right, clients are happy as hell. I'm also a comedian. I've worked with Louis Anderson, Scott Hansen. I've performed with all the legends of Minnesota comedy, including Craig Allen, who is Jennifer Casanova's husband. I don't know if you guys know Jennifer, but her husband is a comedian and a great guy to work with. There's a couple things that have shown up. I was involved in the Geek Calendar. So that's a picture of me in the Geek Calendar. Little difference than the fireman calendar, and but again, it says to be a geek is to be overexcited about the specialized subject or activity to talk about with excessive enthusiasm, which is the same thing you guys do in real estate. And so we're all geeks in this world and we're loving it. So I grew up on a farm south of Minnesota here, south of Minneapolis here, down in Vesely. Anybody know where Vesely is? When I grew up, our house caught on fire. Terrible thing. We're all sleeping. Our prize pig breaks down the pen, breaks down the front door, saves the whole family. Absolutely amazing story.
What's his name, babe?
No. Leave the comedy to the trained professionals. The reporter from the New Prague Times wants to find out what happened, and comes out to the farm and he asks my dad, well, what happened? And my dad says, well, we're all sleeping. House catches on fire. Pig breaks down the pen, breaks down the front door, saves the whole family. The reporter says, that's an amazing story. He says, can I see the pig? And my dad says, sure. Takes him out to the pen. Now the reporter doesn't miss a beat. He notices that the pig's only got 3 legs. And he says, oh my God, I see the pig's only got 3 legs. Did the pig lose a leg in the fire? My dad says, oh no, a pig that special, you don't eat all at once. I am the second funniest accountant in America. The funniest accountant in America is Bob Newhart. Bob started out in accounting, decided to leave. He worked for the unemployment office. He decided to leave accounting when he realized he was paying more money to the people that are unemployed than he was making, and it was time to get out of accounting. So this little slide says, yes, Benny, I suppose being an accountant is kind of like being a superhero, and that's how we believe we are. And so, but we're going to talk about taxes, and you guys are involved in a business that has seen some changes in the last few years, and the changes aren't going to stop. So back in 2017, they changed the rules regarding home mortgage interest. used to be able to deduct home mortgage interest on all of your debt. Then they lowered that to, you can only deduct home mortgage interest on up to $1 million of debt, plus $100,000 home equity debt. So you could deduct interest on $1.1 million. Well, then in 2017, they said if you incur acquisition debt, mortgage interest on your house, you can only deduct interest on $750,000. So that interest applies to your main home and a second home. So you could have two homes totaling less than $750,000 and deduct the interest on those two homes. But again, the $1 million was pre 2017. After 2017, we're back to 750 grand. If you're filing married separate, each one of the individuals can only deduct 375,000. But if you're two single people that own a house, each of you can deduct up to $750,000 worth of mortgage interest. You can refinance your debt, but if you take out more debt, the new rules apply. So let's say in 2015, I bought a house, interest rates were a little higher. By 2019, the interest rates had dropped. So I refinance my debt plus take out some more mortgage. Well, that's a brand new debt. And so I no longer can claim the $1 million interest deduction. It has now fallen to $750,000 because I've taken out a new debt. If I only refinanced the original $1 million, that would still qualify under the new rules. But if I refinanced and took out more debt, all of a sudden I fall into the new 750,000. So I had $1 million of debt. I borrowed another 200,000 because I had some equity, but my mortgage interest deduction now fell to $750,000, probably on a lower interest rate. And so I'm actually losing by refinancing. So again, pre-2017, refinance debt also worked. I could borrow without a problem. After, now we're into the new rules, which say you're only allowed to the 750. Home equity indebtedness used to be deductible. So if you if you went to the bank today and borrowed home equity indebtedness, if you don't use that money to improve your home or buy additional real estate, that you can't use that money to buy a car because it's no longer deductible as home equity indebtedness. So pre-2017, you could take a deduction for mortgage interest, no matter what you spent it on. After 2017, you can only use mortgage interest on the improvement and purchase of a home. Mortgage insurance premiums are no longer deductible. So you take out a mortgage and you don't have enough to get a large down payment. You now have mortgage insurance premiums. They used to be deductible pre-2017. After 2017, they're no longer deductible. The one thing that we have to remember in all this is that at the end of 2025, all of these rules come back. So these rules have been in existence only for 2017 to 2026. Once 2026 hits, we're back to the rules that existed in 2016, which means we're back to $1 million mortgage, home mortgage insurance premiums are deductible, home equity indebtedness is deductible. So it's going to be very important what happens with the legislation for the next couple of years, because either they're going to extend these rules or all of these rules snap back to the rules that existed back in 2016.
Can I ask if you know
Sure.
why they put a time frame like that on it?
The government's budget is always limited because we have to find the dollars. And so if we said we're going to make this permanent, that means the budget has to include these dollars forever. And nobody wants to do that in Congress. They want to just pass the buck. And so they gave us 10 years and said, here's the rules for 10 years. What we do with them after that, that's a whole nother batch of problems. And so you've got, even today, the current Congress is saying our current tax situation isn't sustainable. with a 21% corporate rate and a 37% maximum individual rate. And we'll see also the way that state and local taxes are handled, all those things apply in this 10-year period. It could all snap back to pre-2017, which means we go to a top tax bracket of 39.6. Mortgage interest is fully deductible on $1 million. Real estate taxes and state income taxes are fully deductible, but then it brings back the alternative minimum tax. And the alternative minimum tax is tough on states that have high real estate taxes, high income taxes, which is where you live and breathe. Points and loan origination fees are still deductible on the purchase of a home. And so you pay loan discount points, you pay loan origination fee, all of those are still deductible by the buyer on a home. On a refinance, they're amortized over the life of the loan. The biggest thing, this gets back to the 2017, is the government changed how much state and local taxes we can deduct. And I think it was part of the administration saying, we're going to penalize these high tax states. And so we're going to limit your state and local tax deduction to $10,000. That's all you can deduct in your state and local tax return or in your as an itemized deduction. So I get $10,000 of itemized deductions for state and local taxes. And it doesn't matter whether it's real estate taxes or state income tax or my second home real estate taxes or my third home real estate taxes. All of that is still limited to $10,000. So even if I'm spending $100,000 in taxes, I can only deduct 10 of it. And that created some real problems. And the states kind of got together and said, hey, wait a minute, we got to do something. And so they convinced the federal government to allow for what they call a pass-through entity tax. So if I own a business, I own an S corporation, I own a partnership, and I have income flowing into my return on top of my wage income, on top of the state and local taxes, I'm paying a lot in state taxes. So the state of Minnesota top tax rate is 9.85%, and it doesn't take long to get there. So we basically look and say, Minnesota tax rate is 10%. And if I have a business and I make $100,000, well, there's $10,000 of state and local taxes on top of my real estate taxes, on top of my wage taxes. And so I guarantee I'm way over the $10,000 limit. But they said, hey, if you've got a business, outside business, an S corporation, a partnership that is paying you income, we'll let you take a deduction for that state and local tax so that you don't have to add it to your itemized deductions. So I take my S corporation income, I pay the state of Minnesota directly state and local taxes, and therefore I get a deduction for it at the corporate level, which I'm not getting if I add it to my itemized deductions on my personal tax return. That's fine, but it created a whole batch of new rules, new problems, and new ways of dealing with it. So if you've got a business where you're operating your real estate business in an S corporation environment, it can pay its own state tax and thereby get a tax deduction for it that you're not getting because of your itemized deductions being limited to $10,000. Problem is, 2026, we snap back to the old rules and all of this pass-through entity tax deduction goes out the window. Now, again, today, I can't tell you what's going to happen 2 years from now. We're going to find out probably at the end of 2025 what's going to happen in 2026. And so there isn't going to be a lot of time to plan and prepare for it. But if you've got an S corporation, there's an opportunity. If you've got a separate partnership that is recording your real estate activity, then it's worth really pursuing this pass-through entity tax. If you are sitting around, and we're going to talk about S corporations and partnerships, because everybody has probably heard, you've got a couple of realtors in the office here that have their own separate S corporation, and they love it. But they're also very successful in generating some real dollars through that S corporation. There's a point where it doesn't make sense to have a separate S corporation if you're not doing a lot of real estate sales. You know, there's no sense. Pardon? Yeah. I tell people when they say, should we set up an S corporation? I put the number at about 100 grand bottom line before I would even consider it. Bottom line, net profit, after all your deductions, everything. Because what happens when you set up this separate S corporation is the government says, well, you're going to pay yourself payroll and a reasonable compensation. Therefore, you're going to have to pay yourself just like you were an employee. And normally as a sole proprietor, that bottom line is hitting your tax return, but it's also subject to self-employment tax. One of the biggest reasons for setting up the S corporation is to minimize how much of that FICA tax is taken out of your pay. And it becomes a hassle if you're not generating enough dollars. So you've got a separate tax filing, you got payroll filings, you've got the government looking for information from you in different ways. So just because we can deduct the state and local taxes isn't the only reason to set up the S corporation. It would be, are we making enough? If I'm generating 200 grand bottom line every year, that's a no-brainer. I'd set up the S corporation. You operate all your business expenses through there. The net profit flows into your tax return. You pay yourself a salary out of that, including some FICA. So you've got income flowing out to your tax return. There's definitely good reasons for doing that with the S corporation. But we really got to justify it with the amount of money that we're making, because you got to pay an accountant to have a tax return prepared. You got to pay payroll services to have the payroll taken care of. Because if you make one mistake on the payroll, the penalties are going to far exceed anything you would have paid to have it prepared. So the rules regarding sale of your principal residence, and I think you guys probably know this, but I'm going to run through them anyway. Every 2 years, I can sell my house and take that in gain up to $500,000 if I'm married, or $250,000 if I'm single. Take that gain and put it in my pocket. I don't have to reinvest it in another property. I don't have to do anything with it other than accumulate those dollars. This was at the time what we thought was the greatest thing in the world. And this came about with Clinton. And I think he was throwing a benefit out to his California residents saying, hey, we'll let you exclude up to $500,000 of gain on the sale of your house. That's great. But now in California, the gains are a lot bigger and they're still paying capital gains tax on it. And so the old rules were, as long as I bought a house more expensive than the one I sold, keep increasing the value of my house, I didn't have to pay tax on the gain. Well, what was happening is people started to downsize. So I'm not reinvesting all the money that I had sold on the other house. And so now here's how we fix that. We say, you can sell your house and exclude up to $500,000 of gain on the sale if you're married. That's great. It's wonderful. Again, as you see mom and dad slowly get out of their house and get to a townhouse, the problem is townhouses aren't any cheaper than the houses that they're selling. And so they're not excluding a lot, but the gain that was there can go in their pocket. They don't have to buy another one and have to keep reinvesting in order to avoid that gain. So you can do this as long as you've lived in the house 2 out of 5 years. And so even if mom and dad go to Florida for a couple of years, we still have time to sell their house and exclude that gain. You know, you've got basically that 3-year window to figure out, what are we going to do with mom and dad's house while we wait and decide, do we keep it? Do we sell it? What do we do with the gain? And again, this is available if you live in that house as your principal residence for 2 years, which could be the greatest thing in the world. I buy a house that needs some work, fix it up, hang on to it for 2 years, sell it, take the gain, put it in my pocket. Go out and buy another house, live in it for 2 years, fix it up, sell it, take the gain, put it in my pocket. Could be a great deal as long as you can convince your spouse to move every 2 years, which is really hard to do. Related to the houses, there's some energy credits that came into being. They've been around for a while. The infrastructure bill that was passed last year added some energy credits, and there's some real opportunities we don't want to miss. As long as you are buying improvements to your house for windows, doors, air conditioners, furnaces, there's a credit as long as you're buying energy efficient items, and nobody's buying non-energy efficient items. So when you put in new windows, you put in new doors, you put in a new air conditioner furnace, that provides you some additional credits. And the credits are probably in most cases anywhere from $200 to $600 of reduction in your federal income tax for these energy credits. And so remember that in your own house, we forget, wow, we put in a new front door, we put in some windows. Well, there's some credits that are available. Make sure you capture those on your properties. Everybody gets a furnace at some point. Make sure you go ahead and get those credits. There's also the residential energy efficient property credit, which is roughly 30% of solar panels, solar electric systems, geothermal heat pumps, anything that we can do to improve the energy efficiency of that home through solar, underground water, those kinds of things. The credit is 30% of the amount you spent. And so I had a client call yesterday, we're in Arizona, I can get some panels on my roof for $11,000. The government's going to reduce their taxes by over $3,000. And so their net cost is only 11 grand. Their energy improvement should make up the rest of that difference over probably a 20-year period. So if it's going to happen overnight, I wouldn't get too concerned. If you're selling your house in a couple of days, couple of years, I wouldn't put the solar units on. But if this is going to be my place and we've got good sun, the solar panels are starting to really look attractive, and the return on your investment happens a lot sooner than it used to in the last number of years. So
Actually had like a online discussion about this the other day, because there's somebody that's selling a property with solar panels, and like, how does it make an impact on the value of the house? Some of it depends whether there's still outstanding debt on the solar panels, or if it's actually starting to pay off.
yeah,
It's like for a little like 50-50 here, whether it's really benefit.
Yeah.
It's like a swimming pool in Minnesota. Like,
well, yeah,
people don't want that.
right,
And it actually is like a negative trying to sell people.
right,
house people.
right. But with the number of electric cars and having to charge those at your home, and the units you have to buy, and the amount of energy that those require in order to do that, and that's very widespread now. That the cars are becoming very prevalent on the road, and so what are you using the solar panels for? If and I've got clients that are actually buying stands for them, and they've got them in the back, the back area where they're collecting more than they need. Yeah, they're collecting more than they need, and trying to sell it back to the power company. And so, but I did talk to a guy last week that told me his energy bill in Arizona is about $50 a month with 2 air conditioners because of the solar units that he has on his home. Yeah. Who here is a qualified real estate professional? Everybody here is a qualified real estate professional.
Qualified as what people have been talking about.
Well, the IRS has a different term for qualified versus, and so there's an opportunity that realtors have that accountants don't have. As a realtor, you are able to buy rental real estate and deduct the losses from any rental activity against the rest of your business, your personal income. Okay, so the rules say that if I own a rental property, it's considered passive, unless I'm a realtor that is a qualified real estate professional. Then that rental activity is no longer passive. It's part of my business income and can be offset against my business income, personal income, wages, anything else on my tax return. Now you say, well, why is that a big deal? As an accountant, and if I made more than $125,000, I start losing the ability to deduct a passive loss. So you and I have a rental property – and we lose $10,000 on it. I can only deduct that 10,000 if my income is below $125,000. You can deduct that $10,000 no matter what your income is, if you're a qualified real estate professional. And so my income goes over 150,000, there goes my $10,000 deduction currently. It accumulates and will offset passive income in the future when I finally sell that property. But I'm not seeing any current benefit from the $10,000 loss that I just, that just occurred this year because of the rental activity inside my return. You, however, have now saved taxes on that $10,000 loss every year that you claim it, and ultimately reduce your current taxes, where I'm potentially reducing future taxes down the road.
And it'll also be for like property managers and stuff, but like not just for realtors.
It is for real estate professionals that are in the development, construction, acquisition, conversion, rental, operation, management, or brokerage of real property. Only if you own more than 10% of the business.
Right, let's say you own like 10 properties and being the rental manager.
Well, the owning of those properties would probably get you there as the acquisition of real estate rental properties. So you don't have to be the manager necessarily, but you do have to do some work. And the rules basically say, in order to be a qualified real estate professional, more than half of your time has to be spent on the real estate activity. So if you got 10 properties, you're going quite a bit. You're handling them, you're dealing with them. But if you've got a full-time job and you're doing this at night, can you justify saying more than half of your time? You have a full-time job, that's 2,080 hours a year as a non-real estate agent, okay? So I've got 2,080 hours, which means I have to put in another 2,080 on the rentals in order to be able to claim that I'm spending more than half my time. So the likelihood, if you've got a full-time job, to get it to qualify is going to be tough. And you have to put in at least 750 hours towards the rental the real estate activity. So you as agents, I guarantee you're spending more than 750 hours. If you are working another job, you really need to monitor the hours that you're spending on that job versus the amount of hours that you're spending as a real estate professional. Because if you spend too much time on the other job, and here's a good example, I got a mortgage guy. Mortgage guys don't qualify. You know, they don't own property, they don't manage property. Even though they're in the real estate business, they're in the mortgage business. They're not in the real estate business. Interest rates are 3%. They're going gangbusters. He's working 2,000 hours on his mortgage business. Even though he's got some rental activities, he can't spend that time on the rental activities. He's got managers and taking care of it. Now, interest rates go to 7%. All of a sudden, nobody's refinancing. I got plenty of free time. Now I've got the ability to spend more than half my time on the real estate business and more than 750 hours. So you're absolutely right. It's tough, but I think it's easy if you are in this business full time. You have the opportunity to be able to claim rental losses against your income. So what does that mean? It means if you've got the ability to buy a rental property, go get one. Yeah. It reduces your taxable income, builds ultimately for your retirement.
But there's also the argument that if you're owning rental property, you're at loss.
Well, but the losses could be because of depreciation. Okay, so if you're negative cash flow, there's a point in which you can't sustain that anymore. But if the value of the property is increasing, the negative cash flow doesn't mean anything when the value of the property is going up faster than my out-of-pocket cash flow. So, and you're absolutely right. Correct. So I buy a house, yep. The wear and tear, even though the wear and tear is not an issue because the value of the property is still going up, But it gives you a tax deduction and it's in the code, so you're gonna take the depreciation that's allowed to you. Yep. Cost segregation is, I'm not gonna say it's really new, but it's become more affordable, okay? Most times you say, well, if the property is under $1 million, it's not worth the cost segregation. That's changed a lot because the cost of cost segregation studies that are being done by the engineers and the accountants out there has dropped dramatically. And if you can get one done for $750 on a $500,000 house, it accelerates the depreciation. Now, let's kind of talk about that. Inside my rental activity, I own a building. Part of that building is land, or part of that property that I purchased is land, and some of it's building. So let's say 15% of the property was land. The other 85% is the value of the building. And I spend $1 million on that building. 150,000 represents land. The other $850,000 represents depreciable asset. Now, if this is residential rental, I can treat it on a 27.5-year life. I'm getting about 4% a year deduction for depreciation, which means I'm deducting $32,000 on that $800,000 value. But I'm only getting it spread over the 27.5 years. What the cost segregation studies do is they come in and they say, part of what you bought isn't just the building, it's the components inside the building. So it's the light fixtures, it's the cabinets, it's the appliances. So we're going to take part of that $800,000 analysis and break it down even further to get shorter lives on the cabinets, the windows, the lighting systems, the electricals, some of the things that were necessary and get us a shorter life. What we've found is that most of the cost seg studies say get you to about $11,000 of cost that you can use a shorter life on. Whether it's the parking lot, which would be a 15-year asset, not 27.5. Again, cabinets, those kinds of things are 7 years. So with the bonus depreciation and some of the things that you could end up writing off, most of that 11% in the first year, or at least within 7 years, not 27.5 years. And so you have to look at what is it going to cost me to have the study done and what benefits do I get from the deduction right away. In all likelihood, it does make sense. Like I say, with the cost coming down dramatically on these studies, having a cost segregation study done when you buy a piece of real estate, or even if you've got real estate in your portfolio, they can do a cost seg study on a property that you own for 5 years, 10 years, and break apart that $800,000 portion into smaller sections. And like I say, is it worth doing it for a $200,000 house? Probably not, but you get up to $500,000 and yeah, it's probably worth taking a look at, because if I can take 11% of that $500,000 house and accelerate depreciation on 50 grand, now I'm really taking advantage of the tax law and using it to my benefit. So yeah, cost seg studies, and again, they're not brand new. It's just that the costs have come down where it's reasonable for everybody to have those done. It used to be just commercial real estate that we had them done for. So choice of entity. I'm guessing most of you here are sole proprietors. And so you're filing a Schedule C form on your personal tax return, recording your income, offset by your expenses. You may have an S corporation, you may have a partnership that operates your real estate business, but in all likelihood, you're probably operating just as a sole proprietor. You get a 1099 at the end of the year, you record your expenses against it, the net bottom line flows into your tax return. You get a tax deduction or income from that operation. Partnerships is two people coming together doing the same thing. They file a partnership tax return, each picks up their share of the income. Both the sole proprietorship and the partnership income probably going to be subject to self-employment tax. And self-employment tax is FICA for the non-employee. So I have a job as an accountant. They withhold FICA from my paycheck every week. I get my FICA taken care of. I sell real estate on the side. I have $10,000 of real estate business income. I have to pay self-employment tax on that $10,000, which would be roughly 15.3% of that $10,000, because I'm now the employer and the employee. Over as an employee and as an accountant, I only have to pay half of it. The employer has to match it. But as a self-employed person, I'm both the employer and the employee. So what I had taken out of my $10,000 for myself, the company matches, and it equates to about 15.3%. Corporation, you probably won't be operating as a C corporation. This is 3M, IBM, those are corporations. But you may form a corporation and make an S corporation election, which is a flow-through entity, passing that income off to you. Now, the one term that's really more of a legal term than it is a tax term is limited liability company. Most of you have a sole proprietorship in place. The reason you would set up a limited liability company is if you want some additional protection for your family. So the limited liability company gives you sort of a cover over your entity, so that in case somebody slips and falls, somebody gets hurt, it limits how much liability you have as an individual. This is a non-tax item. This is strictly a liability protection entity. You may want to consider that if you're not yet using an LLC to protect some of the things you do. Now, you probably have, errors and omissions insurance and those kinds of things to take care of some of that, but there's still ways of suing you as a business owner. This helps protect that. And you should talk with your attorney before you do that, but it's worth considering. It's easy to do. Secretary of State's website has formation of limited liability companies. Shouldn't be a big deal. And there's also trust. So these are the main types of business entities out there. You're not going to be operating under a trust document. Again, the limited liability company limits how much you can be sued for to whatever you have in that entity. So if I have a rental activity and I stick it inside a limited liability company, I can only lose what's inside that limited liability company. So you have a rental property, they're making meth, they explode the house, the neighbors get hurt. I get sued because I allowed them to make meth in my rental property. I can only lose the rental property. They can't come after my home, my cars, my kids. They only can get what's in that rental activity.
Do you have to have an LLC? Or does the S corp provide that same protection?
The S corp does provide that protection. Yes. The a limited liability company can be a trade or business or investment. So again, you can use it for rental activity. You can use it for your real estate business if you want, but you would have two separate LLCs, one for your real estate business, one for the rental activity. The one thing about the limited liability company is it can be taxed in so many different ways. For instance, it can be taxed as a corporation. It can be taxed as an S corporation. It can be taxed as a partnership and a sole proprietorship. So we're basically having anybody who wants a business entity to start with an LLC. And then from there, we make the tax election down the road as to what's best for them. So you have a sole proprietorship, you make an LLC, you set up an LLC, it operates your sole proprietorship. Down the road, if we decide to make this LLC an S corporation, piece of cake. We just turn it into an S corporation. We turn it into a partnership if we get two owners. It's easy to do, but once you've made that transition from sole proprietorship to an S corporation, things get a little bit tougher and you can't flip-flop back and forth. You're going to be an S corporation until you dissolve or get rid of that S corporation. Same thing with a partnership. It'll be there for a while. So you got to be a little careful making that transition. Again, the corporation is a separate entity taxed on its own. Whereas an S corporation is a flow-through entity, it rolls into your personal tax return. The sole proprietorship rolls into your personal tax return. The partnership rolls into your personal tax return. All of that income is taxed to you individually, not as a separate entity, except for that pass-through entity tax that we had talked about earlier. If you're going to pay the state income taxes directly through your flow-through entity, other than your sole proprietorship. That's the one disadvantage of the pass-through entity. If I have a sole proprietorship and I'm making $1 million, I still can't deduct my state and local taxes on anything more than the $10,000. Whereas if I have a corporation, have an S corporation, I have a partnership, I can deduct those pass-through entity taxes at the state level. It's hard to see. This is the sole proprietorship schedule. Basically, gross income, all your expenses, you got commissions up to other agents, some advertising, some insurance down here. We've got some taxes and supplies, travel, some utilities and cell phone, that kind of stuff, and some other expenses that you have, supplies and computers, internet, all of those things. Any questions on the sole proprietorship stuff? There's retirement plans available. And so then when I talk about, my clients wanting minimize their tax bill, provide for a good retirement, protection for their family. Well, the protection for their family is the limited liability company, errors and omissions insurance, those types of things, disability insurance, life insurance on you. The minimize the tax bill, well, we take care of that inside the tax returns. And then they want to be provided a good retirement. Well, the same retirement plans that are available to large corporations are available to you as realtors. There's just different kinds and some that are easier and harder to use. For instance, the Simplified Employee Pension Plan, the SEP plan, allows you to contribute into a retirement plan and take a deduction for up to 20% of your net profit from your business. So you make $100,000, I can stick 20 grand into the SEP plan. Works great unless I have an employee, because now I got to contribute 20% of their salary into the retirement plan. So it works great as a sole proprietor, one person, no employees. Simplified Employee Pension Plan is a nice and easy way to deal with it. There's the Simple Plan, which operates almost like a 401k plan for small employers. Each individual that would be in the plan has an IRA account, and it's dealt with directly with the broker. It's similar to a 401k because the dollars come out pre-salary, and no different than the 401k plan, except that a 401k plan is costly to have. You want more employees. You don't want just one employee participating. And so 401k plans are great. They allow you to take pre-tax deductions of your wages, stick them into the plan. They allow you to contribute to Roth IRAs and not get a deduction, or Roth 401ks gets you some dollars into a non-taxable retirement account. And the maximum contribution in any of these plans total $65,000 for last year. And so there's some really good things. In addition to these types of retirement plans, you also have the Roth IRAs, the traditional IRAs. Again, Roth IRA is a great deal. You don't get a current tax deduction for it, but the money grows tax-free till you retire and pull those dollars out. And they've made some changes as to the distribution rules, but you're not required to take the distribution the distribution money out. So everybody should have some Roth money that if I'm never going to spend it, those are dollars that my kids are going to inherit, because they can wait 10 years after I die, pull those dollars out. And so I want to make sure everybody understands I can put money into a Roth today. Yes, I have to pay tax on those dollars. So if I stick $7,000 into a Roth IRA, because I can, that 7,000 is not deductible, but it grows, and it grows tax-free. And whether I take it out or my kids take it out and it's worth $100,000, no tax is paid on that growth from the 7,000 all the way up to the $100,000. So Roth IRAs, Roth 401k. So if you're in an employer situation and have a 401k plan at your availability, my guess is you've also got a Roth feature in there. And so some of your dollars should really roll into that Roth to give you that tax-free growth over time. Nothing too exciting on the SIP. Again, the SEP plan, you can make that contribution until the due date of your tax return. So you really have until October 15th if you've extended your return to make that SEP contribution. The simple plan is, again, is the most cost effective, but you have to put in lower contributions than you would in a 401k plan. 401k plan allows for more contributions, but there's more testing and things that have to go into that plan. And so the annual cost is probably $2,500 to $3,000 to have that plan in place. And you're only going to do that if you've got a number of employees. Other deductions, charitable contributions. We always like to remind everybody, if you have a charitable contribution of over $250, you need a receipt. You should be getting a letter from the organization saying, thank you for your contribution. You receive no benefits from our organization for this contribution. So if you're making a donation to the M Club at the University of Minnesota because you want to get good seats at the game, in all likelihood, you're getting some benefit for your contribution. But if you're sending money over to the Salvation Army, all likelihood that's money that's fully deductible. But again, if you contribute more than $250, you need a receipt. Same thing applies to donations of clothing for furniture. Again, I take what I believe is $1 million worth of stuff to Goodwill. I'm limited as to how much I can deduct, because if I make a donation over $5,000 to Goodwill, I have to get an appraisal of those items. So now I got to find somebody who's going to appraise my pile of junk and give me a tax deduction for it if they can actually do the appraisal. So most cases, if you've donated all the furniture from grandma's house because you think it's worth $100,000, you're going to get a $5,000 deduction unless you have it all appraised before you give it. And again, you need the letter because it said you've now contributed more than $250.
That cumulative or individually?
If it's the same type of thing, so let's say I bring books to the store every time, or to the Savers every week. Yeah, it would be a cumulative, because you're donating the same type of item or to the same organization. And so vehicles, we're back to, every December, every car dealer knows all the tax rules related to what you can deduct for your vehicle. If I buy an SUV, I can deduct up to $25,000 of depreciation in that year. So I buy a $60,000 truck. Good luck finding that. I can deduct $25,000 for first year, for the year of purchase, and then the remaining $35,000, I get a portion of that in addition to the 25 that I'm taking in the first year purchase. Those limits are multiplied by your business use. So, and again, the good thing about buying a car on December 15th is I only have 2 weeks of business use. So I drive that car exclusively for business, and now I got 100% business use, get to take all $25,000. Same thing with depreciation. If I'm only using the car 50% for business, I only get 50% of the depreciation deduction. The SUV also must be more than 6,000 pounds, which the Tahoes, the Range Rovers, those kinds of things are all in excess of that. The electric car we're finding is, because the batteries are so heavy, is more than 6,000 pound gross vehicle weight. And again, it's multiplied by my business personal use percentage. Other deductions last year, the auto mileage rate was 65.5 cents. For 2024, it's 67 cents a mile. So you either get to take mileage times 67 cents, or you get to take your actual business expenses times your business use percentage. And once you've made that election, you have to retain that for the entire life of that car. So if I buy a car and want to write off the 25 grand this year, I'm stuck with depreciating and writing off actual expenses for the rest of my time, which means I have to accumulate all the receipts. I have to calculate, the portion of my insurance and any interest that I pay on the loan to buy the car. All of those costs are accumulated every year that I own that car, multiplied by my business use percent. That becomes my deduction for the year. If I use mileage only, I just need my calendar to say where I went and multiply it by the 67 cents a mile. That's my deduction for 2024. Business meals are 50% deductible. Entertainment is not deductible. Snacks are 100% deductible. So as long as they're providing snacks, we have a good deduction. The IRS, the state of Minnesota, have agents that are pretty new. You know, the IRS want to just hire 80,000 new agents. Good luck finding them. So they're new, they're inexperienced. And so they spend the bulk of their time on the simple things in your tax return. They want to know where are your receipts for food and entertainment and charitable contributions. They're not concerned about all the business things that you're doing because they don't understand them, but they do understand charitable contributions. They do understand, you know, meals and entertainment and those kinds of things. Those are the receipts that they want to look at. And that's where they're spending their time auditing. So document. It's who, what, why, where. Just like we were in 5th grade writing a paragraph on a story. They want to know who, what, why, where. So you go have dinner, you got to tell them who you went with, what you talked about, and where you're at is on the receipt. So every time you pick up a receipt, you're going to want to write on there. The supplies you got at Target, you want to know what are you using those supplies for. Charitable contributions needs canceled checks along with the letter that you got from the charity. Questions? Only a million. Sure.
How, so I have 2 children. I've heard that I could pay them a set, like, I don't know how much up to.
Yep.
And that would be lowering my income.
Absolutely.
Okay.
As a sole proprietor, I can hire my children and pay them and not withhold FICA taxes on their wages until they turn 18.
And then can that money be used to pay for things for them during the year?
Absolutely. It's their money. They can do whatever they want. Yes. Okay, let's talk about the problem.
Yeah.
These kids are going to daycare.
Yeah.
Do they know how to mail out stuff properly? Do they know how to vacuum the office? They don't do it at home. Why would they do it at your office? You have to justify what they're doing as if you're paying somebody else to do it. And so this is where the IRS, you know, because what was happening is I can make a $7,000 IRA contribution for my child. So I pay them $7,000 and it goes right into an IRA. Would you do that with any employee that you have? No, you would pay your employees every 2 weeks for the services that they're providing you. And so you can always say, well, I paid them once a year. You don't pay employees that way. You pay them every 2 weeks. You have to treat them like employees. Now, the way that you see it happening a lot is I've got brochures with my kids' pictures on them because they're now actors. And now I'm paying them for advertising, not for vacuuming and mailing and typing letters and signing closing documents. You know, so you have to justify what they're doing in order to pay them. You know, now you're at the parade, you know, and your kids are all in there with the Pemberton float and off we go. And so you pay them for that time, but you can't pay them $7,000 for a 2-hour parade. So you really have to be careful. It can be done. And again, you just have to file a W-2 at the end of the year, but no FICA and Medicare withholding or, you know, so it's easy. There's no taxes taken out. You still have to file the form. It would, if they earn more than, let's say $10,000, then they're going to pay some income tax on it. But up to that level, you're not going to have a problem with a W-2 with no FICA and Medicare on it because they're working for your sole proprietorship. But you have to justify the work that they're doing. And they could be putting up signs, they could be doing those things, but if they're in daycare, they're probably not as easy to treat them as employees.
So I actually did that with my daughter, when college and, but she also had another job. And I did it thinking that, oh, this is a better way for me to write off her tuition. And I accidentally paid her too much and she had to pay tax on it. So it kind of like screwed her over versus like helping her.
Well, but you got a deduction for it, which saved you more than she
Yeah,
ultimately paid.
but then I ended up paying taxes that she had.
Yeah,
She had.
yeah,
So like, be careful, like.
a lot of work.
It's, yeah.
But again, you can justify it with,
Oh,
but again, she's, and well, she could have been 17 still.
she was 19.
Yeah, but see, then you should have filed, and paid, fight the taxes on her, so. Oops, this is with that, you know, I had a client this year that, bought his daughter an electric car, put her name on it. She got a $7,500 credit. Except she paid no tax, and you can only use the credit against tax. Made a mistake, Dad, should have called.
Someone wants to know, can we write off client gifts we purchase at closing?
I had a realtor that, sent me a gift for 5 years after we had moved, which I thought was the greatest thing in the world. Every year on the date of our anniversary, a new gift would show up. And, I thought, well, that was pretty cool. But then the next house that we bought, I used another realtor for, but I understand what he was doing. So yes, you can make gifts to your clients. The gifts are limited to $25. And so you can't even get a Caribou gift card for that, where they would be happy to get that item. So yes, you can make gifts. I would call them marketing materials more than I would call them gifts, and not limit it to the $25. So I don't have any tax returns that have gifts on them. Advertising, if you're buying a sign at the golf tournament, that's advertising. That's not a donation to the golf tournament. Okay. So take, how you call something, how you word it is very important when you're looking at your tax return. As you look at these expenses, you want to justify them towards my business. And so anything that I can do, again, who, what, why, where, why would I pay money to this scholarship program to have a golf tournament? Because 150 people are going to walk past that sign in addition to the ones that came to the dinner. And that's advertising. That's not a donation to the charity. This is the last minute of accounting, free counting that you're going to get. So you may want to come in with a couple more questions.
But you confirm taking out the clients?
I had, every year we sit down and try to figure that out. Last year I had, we had hired 3 people. Great, we're set. Everything's good. I had a broker call me and said, hey, this financial advisor that I've been sending clients to died. The accountant died. The accountant died. And they all need someplace to go. I'm like, okay, well, yeah, I can take them on. And they are happy as heck. They paid whatever I asked them to pay. They never had a problem. Thinking, yeah, I can absorb a bunch of new work. And then in February, I had one guy disappear because of mental illness. One guy disappear because of alcohol, and a lady that went to the Mayo Clinic for breast cancer. And so within 3 weeks, I lost 3 people at the peak part of our time. And so we are selective as to who we take in. I understand your problem is that there's nobody out there looking for work. If you find an accountant that has nothing to do, it's either because they're no good or they're new into the business and so you just, so yes, I'm accepting new clients, but we have a minimum that we gotta deal with, and I can talk to you about that and let you know, but yeah, there's such a shortage out there finding somebody. If you're not complicated, Block can still do those returns. Um, but, if you've got issues, that's when you need a CPA to be involved in your life. And, the problem is you're paying a lot for that now. The firms I talk to, the bigger firms, I mean, their minimum is you better be able to come to me with at least $2,000 worth of work. Well, that's not an individual return. They want a business. They want multiple entities in order to justify taking them on. And that forces us to drive our rates up. And so
And preparation fees are also deductible, correct?
they used to be, and the accounting lobby is so stupid that they allowed the individual income tax preparation fee to fall into that miscellaneous itemized deduction category that's no longer deductible. Now, work that's related to your sole proprietorship business is deductible. So a portion of your tax preparation, which applies to your sole proprietorship schedule, is deductible. But you cannot deduct tax preparation fees. But it may come back in 2026.
If you not bookkeeper fees?
Yep.
Like by the
Yep. Yep.
bookkeeper.
Yep. Yep, and a portion of your tax preparation related to that part of the business inside your return would be deductible. So yeah, I don't get it. The people that you want involved in making sure that the tax returns are prepared properly, their fee is no longer deductible. We missed that one. I don't know how we were all working during that time when they were talking about it and missed the deduction, so.
This might, well, you guys probably all know this too, but as this is my first year selling real estate full time, should I be paying, is there a minimum amount of money that I bring in of when I should be paying quarterly taxes?
The quarterly taxes are required when your tax will be more than $1,000 that you will owe. So in year, at the end of the year, the total is more than $1,000. So, but there's a couple ways of getting out of the penalty for not making the estimated tax payments. You can either look at last year's tax, and if it's under $100,000 of income, you have to pay in 100% of last year's tax. So last year's tax return, I had $10,000 of federal tax on it. As long as I make estimated payments at least similar to that $10,000, I don't have any penalties. But if I owe more than that this year and I didn't make those $10,000 in payments, I'm going to be penalized on the $10,000 that I should have paid in through the course of the year. So if you owe money, you should be paying it in quarterly. And again, you really got to sit down and calculate your tax return and say, here's what it's going to look like for 2024. If I'm going to owe $5,000, I want to make estimated payments. Now the first quarter and the second quarter payments have already gone by. So you have to kind of play catch up here for September 15th, which stops the penalty. Now the penalty is calculated like interest. If you owed $1,000 on April 15th and didn't pay it, they're going to calculate 6% on that until you do pay it. So from April 15th to September 15th, when I now pay it, I'm going to have 6 months of interest on that $1,000 shortfall. It's messy, but yeah.
Also, I don't know what yours was, but is it still in place that if you pay your estimated quarterly and you overpay, they'll give you a return
Yeah, you'll get,
right away?
no.
Cause it's
No.
like with a bigger check, like reporting them to like. I have brokerage paying more than what they estimated.
That would have been when they filed their return, they would have gotten it back. They would have had to have filed their return to get it back.
Okay.
There used to be a situation where you could demonstrate to the IRS that I've grossly overpaid and I'm not gonna owe this much tax and I want some of it back. And then that doesn't happen anymore. So, yeah.
So also being new to the site, not so state last year. Switch this year.
Yep.
So
Well, it's last year's tax return. It has nothing to do with whether you sold real estate or didn't sell real estate. You look at last year's tax, and as long as, if you're gonna make more than you did last year, okay, well then, so, well, that's the other, okay. So that's the other exception. There's two exceptions. Last year's tax or 90% of the current year tax. So last year's tax was $10,000. I pay that in to protect myself. And that's the safe harbor. That's easy. And I just look back and I know what that number is. Or I calculate this year's tax. And let's say I'm only going to owe $5,000. I only have to pay in 90% of that $5,000 through estimated payments this year, and I will avoid any penalties. Yes. That's it. Yeah, it's all part of the equation. You gotta do your return
that
again. and so-
regular job.
Yeah.
actually, job.
Yep.
Taxes.
Yep. Right.
So I would look at what I have paid in taxes thus far this.
That's
year,
correct.
Project out. It's paid out.
Yep. Yep. Yep.
Establish.
Whatever the shortfall is. So you've had $3,000 already withheld from your pay and you need to get to 5,000, you only have to cover that $2,000.
This question, I'm not particular. But uncomplicated.
Yep.
Something like profits.
Have you been doing your own return? You're adding this sole proprietorship schedule into your tax return. That's it. You're not, it's not complicated. It's, you should be able to look at it and say, okay, this is my income. Yeah.
Follow.
Yep. Yep. And you look and go, okay, I made $5,000 net. Okay, I can live with that number, or I lost $5,000. I can live with that number, whatever hits the bottom line there, because it's gonna affect the rest of your tax return. But, as long as you understand that, you're not gonna have a problem.
Right now.
Right. Yep. So, yeah,
It is-
right. But you're in a, if you've been doing your own return, you're not gonna have a problem adding the sole proprietorship schedule, because it'll ask you all the questions in TurboTax. Yep. 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 Yeah.
So all that.
Yeah. Are you gonna send out the PowerPoint? So. And I can't go back to that page that. I can't go back to that page where they had the sole proprietorship schedule up here. Just look at that, insurance and, supplies, it's got it's got a list of all the expenses on it. Yeah, yeah, that's 90% of what you need to know. So. Thanks for coming.
I was saying one time. Yeah, I was just doing.
You didn't believe that we were actually here?
I live way too far.
Okay.
Yeah.
Okay.
It's like, and it's at 12, 10:40.
Okay.
Any other questions? Thank you all for coming. Thank you for having me. I appreciate it. So, yeah. And call me if you got questions. I've got some cards here. Just, you can call, I can answer questions. All I got is a little bit of knowledge. And I can tell you whether it's worth your time and energy to have us prepare your tax return.